Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Wednesday, halfway through the trading week. Welcome to Modern Investing Techniques, episode 48. It's May 20th, 2026, and I'm Patrick in Vancouver. Midweek, let's reassess this week's positions and look for fresh setups. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Canadian investors holding heavy TFSA positions in growth names should watch the 10-year Treasury yield at 4.69% because it is already repricing long-duration assets faster than earnings can offset. Markets closed lower today with the S&P 500 at 7,354, down 0.7%. The NASDAQ Composite finished at 25,871. down 0.8%. The TSX Composite closed at 33,741, down 0.3%. Sticky long-end yields near 52-week highs are shaping sentiment, along with anticipation around tomorrow's NVIDIA earnings. Fresh options flow shows institutions harvesting elevated implied volatility on NVDA, while broader macro concerns around energy inflation linger. That yield pressure sets up a valuation opportunity worth examining more closely. PayPal's depressed valuation combined with $6 billion in annual free cash flow creates a classic buyback compounding setup that retail investors can replicate using simple screens. At roughly 6.5 times free cash flow and a $40 billion market cap, the company can retire a meaningful percentage of shares each year while the multiple stays compressed. The strategy works by holding through the period of depressed sentiment, letting the shrinking share count do the heavy lifting. Then you wait for a re-rating once the market stops treating the business as structurally broken. Implementation is straightforward. Screen for companies with stable or growing free cash flow, buyback authorization above 10% of market cap, and forward price to earnings below 12. Historical parallels include mature pairs in the early 2010s that delivered multi-bagger returns once sentiment normalized. The main risk is continued competitive pressure on branded checkout, which could erode the cash flow base the thesis relies on. That same PayPal setup is also the basis for today's practice investment. This is a simulated trade for educational purposes only with no real money involved. Today's pick is PYPL, PayPal Holdings Incorporated on the NASDAQ in the financial sector. The strategy is a valuation play on durable free cash flow and aggressive buybacks at depressed multiples. This is a same-day flash trade only. The catalyst comes from a Reddit deep dive highlighting over $6 billion in annual free cash flow at a 6.5 times multiple and potential share count reduction that the market is ignoring. The technical setup shows the stock trading well below historical averages. Risk assessment points to competitive pressure from Apple Pay and Stripe that could pressure margins, so the stop would be placed at 8% below entry to cap loss. The target is plus 2% to plus 4% on re-rating momentum if sentiment shifts. Confidence level is medium because durable cash flow and buyback math are clear, but sector rotation into higher beta names remains a wild card. This trade demonstrates how to quantify a buyback yield and compare it against current valuation to identify asymmetric setups that index funds miss. Listeners learn to separate narrative price action from the actual capital return math that drives long-term compounding. While we wait on that flash outcome, here is how yesterday's weekly hold played out. Last week's simulated hold was ACM on an infrastructure consulting contract win that provided multi-year revenue visibility. Entry came at $80.09 on Monday's open and exit at $71 on Friday's close. The result was a loss of 11.35%, or $113.50 on a $1,000 position. The multi-year visibility from the contract was real, yet the position still suffered when capital rotated into higher beta AI names. This produced negative alpha of roughly 10.5% over the holding window. What this teaches us is the need for volume confirmation above the 20-day average before entering momentum trades on earnings beats. Learning from that rotation risk, let us examine a deeper structural issue many Canadian investors face. Imagine you just rebalanced your TFSA and notice 42% of the equity sleeve sits in Canadian names because you understand the banks and energy names better. That allocation feels prudent until you compare it to Canada's actual 3% weight in global market capitalization. The mechanism driving the mismatch is simple. Your job, home, and pension already embed heavy Canada exposure, so adding another 30 to 50% in TSX stocks doubles down on the same two sectors that make up half the index. Professionals routinely check global market cap weights first, then apply a modest home bias tilt only for the dividend tax credit and currency hedging benefits. The biggest misconception is that familiarity reduces risk. Instead, it concentrates sector and currency risk that a simple 20% Canadian equity cap would materially lower. With that allocation discipline in mind, here are a few tools that can sharpen execution. Unusual Whales surfaces real-time institutional option sweeps and unusual activity that retail traders can use to gauge where smart money is placing bets ahead of catalysts. It gives an edge by highlighting large premium collections or aggressive put selling that often precedes support levels, something most screeners miss. Any investor comfortable with options chains should start with the retail subscription tier that includes Mr. Whale alerts. Options Play NVDA Flow Tracker breaks down specific institutional put sales with exact strikes, premiums collected, and notional risk, allowing listeners to map support zones the market is pricing in. It is most useful for earnings week positioning, where implied volatility crush can reward short volatility trades even without directional conviction. Access it directly through the Options Play Twitter feed or their platform dashboard. While you explore those platforms, here are 3 quick items worth watching. Meta begins its latest round of layoffs, impacting approximately 8,000 employees. The move continues the company's efficiency drive and could free up cash for buybacks or AI infrastructure spend. Add Meta to your watch list for post-layoff margin expansion signals on next earnings. ExxonMobil and Chevron both closed higher for 7 straight sessions. The streak shows sustained institutional interest in integrated energy names despite broader market rotation. Trim any overweight energy positions if the streak breaks on volume below the 20-day average. Foreclosures fell 8% month over month, but remain up 18% year over year. The mixed housing data suggests consumer stress is rising slowly rather than spiking. Avoid adding Canadian REIT exposure this week until the trend stabilizes. Our simulated portfolio across 20 trades shows a 55% win rate with 11 wins, 8 losses, and 1 break-even. Cumulative profit and loss sits at negative $4.66. Average return per trade is negative 0.02%, with the best trade of plus 13.36% and a worst trade of negative 11.35%. The current streak is 1 loss, and our AI analysis is learning from sector rotation patterns and adjusting position sizing accordingly. Before we wrap, open your brokerage screener, set free cash flow yield above 8% and market cap under $60 billion. Then sort by trailing buyback authorization size. Note the top 3 names and compare their current multiples to their 5-year averages. That's modern investing techniques for today. If you found this useful, share it with a fellow investor and subscribe wherever you listen. Check the resources page for tools and platforms we discussed. We're back tomorrow. Keep learning, keep investing. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?